Hello, good day. In today's lecture, we are going to solve assignment number 1. In this assignment, the first question we actually have seen on the screen is that which of the following macroeconomics topics issues are and which are microeconomic ones. As you know that the definition of micro and macroeconomics is quite clear. The microeconomics deals with the issues that are related to the individual industries, whereas the macroeconomics issues are such which are related to the overall nation. By keeping that definition in your mind, you can always have a very much distinction about the issues that you are actually having at hand. Like say, for example, if you look at the A is about the consumer spending. Now, it is about all the consumer spending in the country, say, for example. Now, this is the macro issue. It cannot be a micro issue because it is not related to the one particular sector. It's not related to any one particular kind of a firm or industry. Similarly, the subsidies paid to farmers, the farmers are all from the country, but of course, this is not something that is related to everything. Like subsidy is being paid only to just one sector, and that is the agriculture sector. It cannot be a macro issue, so it is a micro issue. Similarly, the level of UK exports or Pakistan's exports, when you are talking about the overall exports of a country, not exactly you are not considering the export of surgical goods or communication goods or rice or flour or something. That actually is the overall export. So it should be a macroeconomic issue. Similarly, the price of DVDs, as you know, that is something related to the one particular product, and that the price of DVD will be an issue that is actually related to the microeconomics. And similarly, the rate of unemployment. That rate of unemployment is something which actually is concerned or that is related to the overall nation, the rate of unemployment. It means that every people or every person that is unemployed in a country basically will be coming under this particular definition. So somehow this is related to the macroeconomic issue. The average wage paid to the textile workers, this is actually, although we are talking about the overall textile sector, but this is not the overall nation. There are a lot of other kind of workers that are working in some other kind of sectors. We are just talking about the average wage that is being paid to the textile workers. So this is a micro issue. The total amount spent by the UK consumers on clothes and footwear, although we are talking about the total amount, but this total amount is just being spent on the clothing and footwear. A consumer may spend the amount on so many things. So the clothing and footwear basically is just a kind of a small part of the economy. So this is again a micro issue. Amount saved last year by the UK households. This is a macro issue because we are talking about the overall saving. The next question in your assignment is about the concept of rationality. How do we define the rationality in economics? According to classical economics, a rational person is the person who takes the best decision in his self-interest. Generally, when you make a rational decision, you actually are maximizing your utility or your profit or whatever objective do you have. On the basis of that definition, if you look at the question number 2, economists assume that economic decisions are made rationally. In the case of consumers, rational decision-making means you have to find out whether the statements that have been given into this particular questions are true or false. The first question is about that consumers will not buy goods which increase their satisfaction only by a small amount. Obviously, this cannot be true because the rational person is the person basically who tries to maximize satisfaction. So anything that increases his satisfaction, he actually goes for it. Say, for example, this could be a false statement. So you basically have got this false statement here. Now, this false statement is it's saying that a person will definitely buy something that actually increases his or her satisfaction, although by a small amount. That consumers will attempt to maximize. The second part of that is that consumers will attempt to maximize their individual satisfaction for the income they earn. That is quite true. Obviously, they are actually trying to maximize. So an individual consumer always look for maximizing utility. So when he actually has got something to actually this actually just maximize satisfaction, he goes for it. The third is that the consumers buy the sort of goods that average person buys. Of course, that is not related to the rationality concept. You do not follow the hard work. You only make the choices about those goods which actually you like or which actually increases your satisfaction. The deep part of that particular question is that consumers seek to get the best value of money from the goods that they buy. And that is what actually is the basic definition of rationality. That the consumers seek to get the best value or the maximum value for the money from the goods that they buy. Like say, for example, they spend their money on those goods and services that actually they like the most, or they give them the highest amount of utility. This question number 3 is about making a list of 3 things that you did yesterday. What was the opportunity cost of each? Have a look at your neighbors list and see if you agree with their estimates of the opportunity cost. Like say, for example, if you look at your students, look at your fellow students, you will find out like, what exactly they have done and what exactly kind of opportunity cost they have paid. Now, in this particular question, that depends on particularly you, like, that will be subjective to your choices. But to understand this question and to do this question, you have to understand the concept of opportunity cost. The opportunity cost here actually means the value of the next best alternative. So whatever you did yesterday, you have to compare the things that you were not doing yesterday. So you can compare the two different activities that you might have performed and the thing you are performing basically. So that actually can give you the idea. Okay. So the question number 4 is about the data sets, like, it's about the PPF. A country, as the question reads, a country is capable of producing the following combinations of goods and services, period per time, assuming that it makes full use of its resources of land, labor, and capital, like say, for example, here. Now, if you look at this, these are the two, actually the things, basically, like say, for example, if the country divides its resources for the production of goods and services. So like say, for example, if it produces or uses all of its resources to produce goods, it actually like, just produce 100 units of goods. Similarly, if it allocates all of its resources for the production of services, the maximum services it can produce is 150. When you have got maximum goods production, your services production is 0. And when you have got maximum services production, your goods production is 0. All right. So, and like, but the countries basically go for the combinations, like, they neither go for the extreme production of one good or the other good. So you have to divide, you have to draw a curve here. And this curve will actually like, help you understand like, this particular kind of a behavior. Now, the question requires draw the production possibility curve for this country of the following diagram. Now, if you take these points together, like say, for example, here, when you make a combinations of them, like say, for example, you must make a coordinates of them, like say, for example, this particular point on this curve, look at this. The first point is this, say, for example, this combination. So like, say, for example, you are producing 100 goods and you are producing 0 units of services. The second point is like, say, for example, you are producing 80 units of goods. And like, if you just project this here, you are producing, say, for example, 50 units of services. Similarly here, you are producing 60 goods and you are producing around 90 units of services, and something similar like happens on all the points of it. So when you draw this curve, what you have to do is you have to just draw these coordinates and you have to just plot these coordinates on the graph here, and that will give you a curve that is called the PPF. What does this PPF show? The curve shows all those combinations of the two goods that a country can produce within a given time period. If a country was fully using its resources, then it would produce somewhere on the curve. If it was if there was unemployment or underutilization of resources, the country would be producing inside the curve, like say, for example, any point here, 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 or anywhere. So if you are producing under this production possibility frontier, like, you are actually not utilizing your resources fully because you are producing here, whereas you can produce like both of those things more. So that actually is not efficient. Okay. So if you look at this particular kind of relationships here, like, with the two goods, this particular relationship shows that the maximum amount of output that you can produce with your available inputs. Now, if you go for the point, the part B, is it possible for this country to produce the following combinations? Like, say, for example, the combinations are 80 units of goods and 50 units of services. Yes, because like that is on the production possibility frontier. Like say for example here, look at this. This 80 is corresponding to something here, like which is 50. All right. So this is possible. 70 units of goods and 90 units of services. 70 units of goods, like say for example here, this is 70 units. And like you want to produce along with the 70 units of I'm sorry, the 70 units of services, and this is the 70 units of services, and you want to produce 90 units of, like say for example, the 70 units of goods with 90 units of services. So this combination actually goes like this, like here. You cannot do that because it's outside the possibility frontier curve. And similarly, 40 units of goods, 40 units of goods, like say for example here, and you want to produce 100 units of services, and that is what basically is like that, like say for example here, this is the point basically is showing you can produce this, although it is inefficient, but of course you can produce this particular output. So although it is an inside the production possibility frontier, but it is possible. Okay, so if you look at here, the question number C. Now, what is the opportunity cost in terms of services of producing 20 extra units of goods when this country is actually producing 60 units of goods? Now, if you are producing, say, for example, 60 units of goods, if you are producing 60 units of goods, it means that you are here somewhere like this. "60 units of goods you are producing here." Now, if from the 60 units of goods, like say, for example, you want to produce 20 more units of goods, like, you want to produce 80 units of goods, say, for example, from the 60 units of this. So how many services you will have to sacrifice? Like, say, for example, here, like, here the services, corresponding services. Look at here, like, there's a 90 basically services you are producing at this point. And at this point, you are just producing 50 services, 50 units of services. So 50 units of services is like this. So here, like, the difference between the 90 and 50 is basically, like it's 40. And that's what basically is an opportunity cost. All right. So if you are producing 20 units of goods, like say, for example, you are here and you want to produce 20 more units of goods, that 20 more units of goods like require you to produce less of the services. Like, you will be producing, say, for example, if you want to produce 20 more units, it means that you want to go from 20 to 40. So you have to reduce your services production, say, for example, 140 to 120. So this is the difference basically of the 20 units. So in that way, you can find out the opportunity cost. So this opportunity cost basically is the cost of producing more of one good when you actually are willing to sacrifice the less of the other good. Say, for example, you want to produce more of the good, if you want to produce more of services, you can only do that if you just produce less of this. If you want to produce more of the goods, like you have to produce less of the services. Okay, thank you very much. For the further questions, let's launch another video.